Good morning, everyone, and welcome to the first in our two-part series webinar on choices in impact measurement and management. Today we'll focus on some of the key choices that help inform impact investors as they design and implement their IMM practice. And we'll have a second webinar in this series next Monday, January 29th from noon until 1 p.m. Eastern Time, which digs a little deeper into some of the common challenges and solutions that impact investors are using to address this key element of impact investing. We're really glad to have everyone on the line with us today. And before we begin, I'll just share a few housekeeping items. First, everyone on the line is muted upon entry, but that being said, we do encourage active participation, so please use the chat function in the lower left-hand corner of your screen at any point during this conversation to submit questions or concerns that you're facing in the broadcast. We are recording the conversation, and we'll be posting this to our website shortly after the webinar today. Before we dive into the content, it'd be helpful to get a better sense of who's on the line. So we'd encourage everyone to share what your current level of engagement with impact investing is. So please just fill out this poll here and let us know where you're coming from, what's your experience. And in the meantime, I'll share the agenda for this conversation. We'll start with a few key findings from a recently published survey on impact measurement and management that seeks to answer three questions. What should I measure? How do I measure? And then what? What do I do next? All of this relates to some of the choices and different paths that impact investors can take in IMM. And then we'll have a discussion among some leading impact investors who are active in this space. We'll hear from Sara Wilson from Nuveen, a TIAA company, Michael Eddy from the Global Innovation Fund, and Grace Horwitz from Blue Haven Initiative. And then, of course, we'll have time for the questions. So again, please submit any questions you have through the chat function in the lower left-hand side of your corner. So let's take a look at our poll results. It looks like we have a mix of folks here, some who are already making impact investments and are otherwise active in the space, and many others who are considering making impact investments and starting to do so. So that's really exciting to see that we have interest from different corners of the impact investing world and those of you who are already engaged and also looking to get more engaged. So thanks for joining us. With that, I'll turn it over to our research director, Abhilash Mudliar, who will share a few more words about why we're all here today.
Great. Thank you, Rachel, and thank you, everyone, for joining us today, and a special thanks to our three panelists who we'll hear from later, Michael Eddy of the Global Innovation Fund, Grace Horwitz of Blue Haven Initiative, and Sara Wilson of TIAA. Before we dive in, I'd like to share some background information about our organization. The Global Impact Investing Network, or the GIIN for short, is a nonprofit dedicated to increasing the scale and effectiveness of impact investing around the world. As a field-building organization, we offer a variety of tools, resources, and programs to advance the development of this industry. For instance, we convene a community of impact investors and other key stakeholders to work side by side to advance the market. Our global membership now includes over 260 organizations. We also design platforms and programs that are free public goods for investors to advance their practice, such as research on the industry. And the key part of our work is to offer clarity around impact measurement and management, specifically by producing research on the topic, by managing a catalog of metrics, including guidance on how to use these metrics, and by providing resources on tools and frameworks for effective practice. The goal of today's webinar is to share information for those interested in or new to impact measurement and management. During our session today, we'll have the opportunity to hear from Rachel, who will present some key findings from the GIIN's first ever Impact Measurement and Management Survey to provide an overview of the key decisions that impact investors consider when developing their impact measurement and management practice. Following this, we'll hear from our panelists who will share their insights about choices they make when developing their IMM practice. And then we'll take questions for a moderated Q&A with our guest speakers to share their insights. Before I hand it over to Rachel, I think it's important to ensure we're all on the same page about the big picture, about what impact investing is, what impact measurement and management is, and why these matter. So impact investments, firstly, are defined as investments made with a deliberate intent to generate social and environmental impact alongside a financial return. They unleash the power of the private sector and of markets to create positive global change that can improve conditions for people and the planet. Impact measurement and management, more specifically, is integral to making effective impact investments. This includes evaluating the effects one's actions have on their various stakeholders, and then figuring out ways to both mitigate the negative impacts and maximize the positive in alignment with one's goals. And this is why we conducted this survey. While impact measurement and management is integral to impact investing, until now there's been no complete picture of investor motivations and approaches to IMM. This survey offers us the opportunity to gain insight into the range of practices currently being used, as well as investors' perceptions of the state of impact measurement and management across the market. From this, we can establish a baseline understanding of trends and developments. We can also identify opportunities for improvement, and we can provide clearer guidance for new investors who are just getting started. So with this, I'll hand it back to Rachel to take you through some key findings.
Great, thank you, Abhilash. So I'm really excited to present to you all today some findings from the first edition of the GIIN's Impact Measurement and Management Survey, or IMM survey. This research represents a really critical moment for the industry. As Abhilash mentioned, impact and impact measurement and management are central to the definition and practice of impact investing. And therefore, they're really critical components of investors' strategies and practices. And yet there's been very little research to date to understand the landscape of activities and approaches being undertaken. And so that's where this report comes into play. From this research, we can better draw insight into the options that exist for impact investors, as well as the opportunities to advance industry practice. This report was generously funded by the Rockefeller Foundation, and altogether we generated responses from 169 impact investors from around the world. So to those of you who are on the line who contributed, thank you very much. And to those of you who would like opportunities to engage in GIIN research going forward, they are plentiful, including our annual Impact Investor Survey, for which data collection is now live. So please feel free to reach out if you'd like to participate. Today we'll cover a number of highlights from the report, but it's just a few of the many data points that are there. We'll talk about motivations, market perspectives, measurement practices and strategies, but again, I urge you to look at the full report, which is available through the research page online for more information. Of course, impact is a defining characteristic of impact investing. And so a key motivation for impact investors to measure and manage their impact is that it helps to drive decision-making, it helps to understand the impacts that they're having, and it helps to improve their practice. Interestingly, over 60% of respondents also engage in IMM because they find that impact data has business value. And of course, these different motivations inform and influence the various choices that impact investors make when designing their IMM practices and developing their investment strategies. Those are the choices that we'll focus on today, specifically these three questions. What should I measure? How do I measure? And then what? What do I do once I have that information? So let's start with the first question. What should I measure? About half of impact investors seek to achieve both social and environmental impact. 40% target only social impact and 10% target only environmental impact. And within these broad categories, there are a number of different impact themes that investors may choose to target. Pictured here are 17 different impact objectives, each of which is aligned to one of the UN Sustainable Development Goals, or SDGs. These goals are a set of ambitious targets that were set forward by the UN a couple of years ago and unanimously ratified by its 193 member states. The most commonly targeted of these themes, decent work and economic growth, followed by good health and well-being, quality education, and affordable and clean energy. And impact investors also consider their work across different stakeholders. For example, impact investors seeking social change most commonly target individuals within a given socioeconomic bracket, women and girls, and the unemployed. Across these different impact objectives, investors consider varying types of evidence, most commonly outputs and outcomes. But we're also gratified to see that over 40% of respondents look to understand the breadth of their impact or the reach of their work. And another 35% look to understand additionality, or whether the effect would have happened without their investment, and the depth or the significance of their impact on their targeted beneficiaries. Investors evaluate these options based on their motivations for measuring and managing impact and their available resources, among other considerations. Then there are a number of different tools or sets of indicators that impact investors can use to capture and interpret data. Most commonly cited is IRIS, which is the GIIN's catalog of social, environmental, and financial performance metrics, cited by 62% of respondents. The UN SDGs and GIIRs are also off-cited. And as you can see here, some of these resources can be used across a portfolio, and others are more sector-specific, such as SPI4 for microfinance, ARIES for CDFIs, and LEAD for green building. Impact investors choose these tools for a range of reasons, such as to reflect impact within a specific sector, or to reflect impact across a range of different investments, the more portfolio view, and to meet LP demands. The next question is, how do I measure? Where do I start? And to decide how to measure impact, many impact investors start by setting targets that define what impact they're hoping to achieve and shape a strategy for measuring progress toward those goals. About 60% of respondents set some impact targets. To set these and to identify corresponding metrics, investors leverage existing evidence which drives strategy and demonstrates their theory of change. They rely on the tools and indicator sets I mentioned on the previous slide. And they look to the UN Sustainable Development Goals. Impact investors set metrics with varying levels of customization. 37% use a standardized set of metrics across all of their investments. About a quarter select metrics based on their sector or impact objectives. And another 20% rely more on customized metrics, metrics selected for each specific investment. To gather these data and drive decision-making, we've asked respondents who from their team is responsible for IMM. Most cited that IMM is a responsibility only of their investment team, or that it's a shared responsibility between the investment team and other staff who are wholly dedicated to IMM. This offers some indication that increasingly, IMM is baked into the core of their organization's operations and strategy, rather than siloed on the side. We find that to be a really nice indicator of progress for the role of IMM in investing. Other respondents indicated that IMM is conducted by external consultants who are often responsible for conducting impact assessments or for managing the routine collection, analysis, and reporting of data. While we haven't explicitly gathered data on the cost of IMM, we did ask what % of staff time is dedicated, which offers some proxy for understanding costs. About half of respondents indicated that up to 10% of staff time is allocated to IMM, and another quarter or so indicated that it's between 10 and 20% of staff time. Of course, as we think about those staff as well as investees, we need to ask the question of how they're incentivized to achieve impact. Across the board, many impact investors cited intrinsic motivations to achieve impact. This goes back to the motivations we mentioned at the top of the webinar. Many investors find impact measurement and management is integral to their work as they seek to benefit people on the planet, and thus they attract employees who feel the same. Of the investors who set impact targets, over 80% offer incentives to their staff and to their investees to achieve those targets. For staff, these incentives take the form of compensation benefits and performance evaluation. And for investees, impact performance is often tied to the investment terms, to the receipt of follow-on capital, and to management structures and compensation. Again, this varies by the type of investor, the asset class of the investment, and the nature of their management style. Now we'll move into our third question. Now that we have the data, what do you do with it? And impact investors cite a multitude of ways that they use the data that they collect. First, they use it for investment management. They're using impact data to drive strategy, ranging from informing portfolio allocations to due diligence to investment management itself. And this offers some insight into the various ways that IMM data can create business value across the full investment process. Of course, impact data are also used to drive impact management and to improve impact outcomes. Specifically, investors use data to communicate results, to improve their processes, and to manage risk. I'll stop here with the research portion. Of course, this is just a small sliver of the data available in the full report, which I again encourage you all to access through the research page on the GIIN's website. But for now, we'll hear more from impact investors themselves who can shed some light on how these various considerations have shaped their IMM practices. And so with that, I'll turn it over to Sara Wilson of Nuveen, a TIAA company.
Hi, everyone. This is Sara. Thank you to the GIIN for asking me to speak today. I sit on our responsible investing team here at Nuveen, which is the asset management brand of TIAA. We are a large institutional investor and have been in the impact investing space for many years. If we could perhaps go to the first slide, I can give you a sense of the breadth and scale of the responsible investment activities that we have here at TIAA. We're going to focus today on a portion of these, but I want to start by explaining all of the variety of work that we do here. First, we have just over $600 billion in our total assets under management that is committed to broad responsible investment principles under the UN PRI. Within that, we have over $18 billion in ESG-focused funds and around $77 billion in sustainability initiatives in our real assets side of our business. But today, we're actually going to be focusing on the specific impact investing portfolio within our general account, which has total investment commitments of just over $1 billion. And I'll be delving into some of the roles and responsibilities between the responsible investment team and our impact portfolio team shortly, but first I'll give you a quick overview of our impact investing portfolio and how it's structured. So we have defined 3 impact themes that guide our investment selection within the impact portfolio. First is financial inclusion, which focuses on the provision of financial services to low and moderate income populations. If you could just go back, yeah, good. And then the second is affordable housing, which is focusing on the creation and preservation of affordable housing units for, again, low to moderate income populations. And then the third is community and economic development. And one important thing to know about our structure is that this is a private equity portfolio, and we are primarily an indirect impact investor, investing through funds, and occasionally investing directly in specific companies that are aligned with these themes as well. So today we're going to be focusing on our private equity portfolio here, but later, if you'd like in the Q&A, we can also talk about some of the other impact measurement work that we're doing in other asset classes. Next slide. So here we have sort of a depiction of the different responsibilities across two teams that overlap and support each other here at Nuveen. Like I mentioned, I sit on the responsible investment team, which is the circle on the right. We provide impact measurement and ESG integration expertise to the firm. I've also worked on designing harmonized impact metrics across multiple GPs through which we invest. And then I also participate in some of the external initiatives that we like to support to advance the practice of impact measurement generally, as well as taking on a lot of broad ESG or responsible investment activities in support of other asset classes outside of private equity. Meanwhile, our impact investing portfolio team are the ones responsible for managing and selecting the investments in that portfolio. They also define the impact themes and underwrite investments within the portfolio. And all of these investments are held internally within our own general account. So when we communicate outcomes from our impact investments, those are communicated internally. And some of the things that we do together are engaging with our GPs on their impact measurement approaches, their progress against their targets, and also working with them to gather and harmonize impact data within a certain theme so that we can compare different GPs to one another. So next slide, I can talk a little bit about the use cases that we have today for impact data. And I think these line up pretty well with a lot of the main takeaways from the survey. First, we really use impact data both at the beginning of our initial due diligence process and also on an ongoing basis to help confirm or demonstrate the strength of the alignment of a certain investment with our themes. So, for example, within our financial inclusion theme, we would look to see if a general partner has a clear definition of what they consider to be a low to moderate income population, such as people living on less than $10 a day, for example, and also a clear understanding of that population's current level of access to those financial services versus what the portfolio companies in their fund might be providing. So, for example, confirming that the target population might have no credit history and then measuring how many people might be able to be assigned a credit score using a mobile platform offered by a portfolio company. And then, no surprise, we also use impact data to measure GP's progress over time toward both business and impact targets. So since all of the lines of business of portfolio companies tend to be double bottom line, we really see a lot of overlap between impact data and business data. So output metrics like the number of people reached by a product or service are useful in generally describing the scale of the business, their target market, level of penetration with the target population, but are also useful in measuring the scale of impact over time. And then finally, we also use impact data, especially within our affordable housing theme, where we have done a little bit more work of harmonizing our impact metrics across multiple GPs. We can use impact data to shed light on some of the strategic differences between general partners within that theme. So, for example, one GP might focus more on greening and preserving affordable housing, while another might focus more on building new affordable housing in underserved markets. And that would become very apparent in the specific impact metrics that we receive initially from those GPs. One might report energy and water savings, another might report the difference between the market rent and the rent at their properties on average. And then once we try and find a common set of metrics that we can use across all of those funds, then we have that additional insight into how those funds might deliver different results on the same metric. So I think it's a case of really sort of a continuous feedback loop between defining those impact metrics, seeing how funds or investments perform against them, and then extracting both business and impact conclusions from that work. So with that, I will turn it back to our moderators and to our additional speakers, and hopefully we'll be able to learn some more from them as well.
Thank you, Sara. And I do just want to reiterate, if anyone has questions for us, please feel free to submit them through the chat function, the lower left-hand corner of your window. And with that, I'll turn it over to Michael Eddy from the Global Innovation Fund.
Great. Well, thank you very much. It's a real pleasure to be able to join you today on this webinar. And what I'll start by doing is describing a little bit about the Global Innovation Fund so you can understand the context in which we're making our impact measurement decisions. So Global Innovation Fund was set up about 4 years ago as a $200 million nonprofit impact-first fund. And we make direct investments, anywhere between $100,000 all the way up to $15 million. We invest in innovations that have a measurable impact on those living under $5 a day and that are backed by a strong pathway to scale. And we're set up as to take this venture capital style approach to investing. And so that means that we can take smart risks, knowing that some of our investments may fail, but others may win and win in a very big way. Our goal, importantly, is to maximize the social returns of the fund as a whole. And so that plays out very specifically in the way that we approach our impact measurement decision. Now, one unique thing about, or one exciting thing about the Global Innovation Fund is that we are an open innovation fund without any sectoral restrictions. So that enables us to invest in a wide variety of different types of innovations, from agricultural businesses to companies, ed tech companies, to companies that are improving health and transportation outcomes. And so when the fund was set up, a number of big questions popped up. How do we deploy our limited capital to innovations that can have the highest potential impact? How do we trade off a health company from an education company? And how do we follow whether our innovations are on track to achieve their ambitious social aims, particularly keeping in mind that these are early stage innovations that may take a while to scale? And so for that, we very quickly realized that we needed an impact metric that could nicely summarize the potential future impact of innovations at scale. And most importantly, we needed something that was rigorous, but most of all, practical for our investment making process. And so if you can go to the next slide, that led us to practical impact assessment. And this is our approach to providing a quick forecast of whether a particular innovation that we're looking at is likely to generate substantial impact. And it's composed of 3 basic parts that you can see here. First is the breadth of impact. So we estimate the number of people who will benefit from a given innovation at year 10 from the date of investment. The second parameter is the depth of impact, so the benefit per person framed relative to a typical user's annual income. And this is the benefit of the innovation compared to had that innovation not existed, so compared to a counterfactual, so the attributable impact of that innovation on people's outcomes. And then third and finally, the probability of success, which captures basically the risk that the innovation doesn't succeed. And this is particularly important for our venture capital style of investing. And in calculating basically this formula that estimates expected impact, what we found is that often order of magnitude estimation is sufficient. So we're asking questions like, is this an innovation that will reach 100,000 people, 1 million people, or 10 million people? Is this likely to be a small change in their lives or a really large change? And we aim to put numbers on all 3 of these parameters. And we've chosen to calibrate this at year 10, not because year 10 has any special significance, but because it's a nice middle ground that gives innovation sufficient time to scale, but not too much time where it's simply too hard to know what the world would look like. So we found that year 10 is kind of a nice middle ground there. And so if you go on to the next slide, and the final slide, in applying this over the past year or 2, we found a couple of things where this practical impact assessment is most valuable. In particular, it provides this nice, convenient, updatable forecast of impact. And we use it across the investment cycle. So we use it when we're diligencing investments, when investments are in our portfolio, and following up after we've already closed an investment, ended an investment. And so we see this practical impact assessment very similarly to how you might revalue the do the evaluation of the financial value of the portfolio. And so just like you would revalue a portfolio of investments periodically, so too do we revalue our impact assessments based on new information. And then secondly, as I mentioned, it allows us to do good enough order of magnitude estimates, and then refine as information improves. And oftentimes, part of our motivation for investing is to actually collect more and better information about, for example, the likelihood of success, the likelihood that this innovation is going to scale, to de-risk it, for example. Or, for example, the depth of impact. So we might do an impact evaluation alongside an investment in order to better calibrate exactly what the depth of impact is of a given innovation. Third, we use this alongside investment-specific indicators that track the performance of particular investments. So for example, one indicator we might have for a particular investment is the number of people reached. And then when we get reports in on the number of people reached and the traction along customer growth, that may lead us to update our 10-year forecasts, either update them up or update them down based on whatever that information is indicating. And then finally, and important for our venture capital approach, this really promotes a portfolio-level view of effectiveness, enabling us to track the total portfolio performance, basically roll up from individual investments to the performance of our portfolio as a whole, and do that across a wide range of different portfolio companies. And as you can guess, the key here is really this depth of impact parameter. And I will say that we complement this with much more data-intensive social return on investment analysis, which we aim to do after each investment closes and also pre-investment for some of our more mature investments. So that was a little bit about brief intro into practical impact assessment. Hope that was useful, and happy to take any further questions during the Q&A.
Michael. So again, please submit any questions through the chat function. But for now, we are excited to be hearing from Grace Horwitz from the Blue Haven Initiative.
Hi, everyone. Thank you to the GIIN for inviting us to participate. Really excited to be sharing our impact strategy with all of you. So my name is Grace Horwitz. I work with Blue Haven's direct investment team. We can go to the next slide. And on this slide, I can start out by sharing a bit about Blue Haven, what my team does, and then we can jump into some of the more tactical stuff around how exactly we go about measuring and managing for impact. So Blue Haven broadly is the family office of Liesl and Ian Pritzker-Simmons. And when Liesl and Ian got married, they decided that they wanted to invest all of their assets in a way that aligns with their social and environmental values in some way, shape, or form. So they've taken this approach across all asset classes, so public, private equities, fixed income, real assets. 100% of the portfolio is invested with a lens for impact. I work with a subset of the family office, which is a $50 million carve-out that's focused on direct early-stage investments. So it looks a little bit like the Global Innovation Fund in terms of our investment focus. My background is in kind of the private equity practice of a consulting firm, and then at Acumen, a venture philanthropy organization that some of you might be familiar with. So both from kind of an investment angle as well as from an impact angle, I've always been focused on direct investments. And as may come up in the Q&A, impact strategies can look really different depending on what type of investments you're making and what your risk return profile is and who your LPs are. So just for context, I'll be speaking to from the perspective of a family office, and that's doing direct investments. So we invest, as you can see here, in quickly growing startups across sub-Saharan Africa, in fintech, renewable energy, supply chain logistics, and talent and human capital. We have 11 companies in our portfolio. And as you can see on the right-hand side of this slide, our team is pretty small. So 3 of the faces you actually see there are investment committee members. The team managing the day-to-day was 2 and now is 3 as of a few weeks ago. So relatively lean on the investment side. And so the reason I highlight this is because team size and bandwidth have a huge impact on your impact measurement strategies. And when I worked with Acumen, just as a data point, we had this team of 5 to 6 full-time staff dedicated to impact, and that was incredible. But that isn't the case for a lot of firms, nor do I see that really becoming the model. So it means that you have to be resourceful when it comes to impact, and can't get too precious around what impact measurement means, and require randomized controlled experiments or very pricey and time-intensive ways of measuring impact. And that can be a debate, and I'm happy to discuss that in further detail during the Q&A. But for now, if you go to the next slide, I can walk you through our process and what we do internally. So our goal at Blue Haven on the direct investment team, and I apologize for any background noise, it's pouring rain here in Boston and against my window, so hopefully it's not too distracting. But our goal is to invest in companies that are commercially viable and have some sort of social and environmental benefit embedded in the core of their business model. And we come from the point of view that if you want to move the needle as impact investors, if you want to attract more capital to the space, you have to prove that you're capable of simultaneously hitting your financial targets alongside your impact targets. But that being said, we don't have a narrow mandate or a specific set of impact metrics that we're targeting. We don't focus strictly on low-income populations. We don't focus strictly on reducing carbon emissions or the like, just because we do work for a family that has a broad range of impact goals, so we have that capability to be flexible in terms of our strategy. And we're comfortable with the fact that we're going to achieve a wide variety of outcomes, as you can see from kind of our 4 fairly loosely defined impact objectives on this slide. And just as an example of that, one of our investments, one of our most recent investments was into a company called Paystack, which is a payments company in Nigeria that helps businesses more easily accept all forms of payments online. So that, as you can probably deduce, isn't necessarily directly serving low-income customers, or doesn't necessarily at first glance fit into certain impact investors' criteria for an impact investment. That is something that we would call more of an ecosystem play in terms of our impact strategy, and that we feel comfortable with as a family office. If you go to the next slide, you can see a snapshot of kind of what this looks like in practice. So similar to what some of the previous speakers said, we try to integrate impact into each step of our process, from that very first conversation with an entrepreneur all the way through due diligence, and continuing that through portfolio management. So when we're doing due diligence on a company, we'll put together a framework that looks something like this. Our bar for investment is that financial success and impact are inextricably linked, and that is something that we don't compromise on. So essentially this means, the more money a company makes, the more impact they have, and the more impact they have, the more money you make. It's this virtuous cycle of impact, and we don't want any divergence between the two, because while I respect the Toms Shoes and Warby Parkers of the world, if you have that type of buy one, give one model and your business is struggling and you walk into your boardroom, often the give one component is the first thing on the chopping block. So it's something that we try to avoid. So we boil down the impact thesis into this pretty streamlined framework of what challenge is the company facing, what value proposition are they providing, what are the desired outcomes, and what 5 metrics are we going to work with management to help measure. And this is, to be clear, not meant to be a reporting burden. This is a practice to help kind of investors and management align on outcomes that they see as vital to the success of the business, both from a financial return perspective as well as an impact perspective. On the next slide, you can see a quick snapshot of kind kind of what we look at on an annual basis. These are the KPIs we have outlined in our due diligence process and have worked with management to define. It's relatively high level, and these are metrics that we want the entrepreneur waking up in the morning. This is the dashboard that he would look at to manage his business, and it also is what we look at from an impact perspective, since the two are closely tied. On the next slide, you just saw an individual company snapshot, and like Michael was saying earlier, we also like to see things at the portfolio level. So these are some headline numbers that we use to understand the scale of our impact across all of our portfolio companies. And we manage 11 investments across sub-Saharan Africa at the moment. And to be frank and candid, these numbers, as you see on the slide, aren't super actionable. Some of the numbers on the previous portfolio company slide, we can actually target next steps and action items based on those. These, not so much. But we use these to communicate to the market the scale of our portfolio, and see how we're tracking against our headline goals as opposed to our individual company goals. And then finally, on this last slide, one of the, we mentioned the SDGs as a common framework that impact investors, people across the public and private sector use as a kind of coherent strategy for making change in the world. And part of Liesl and Ian's goals as a family office is to build up the impact investing ecosystem, and that means aligning with other investors and kind of speaking the same language. And as we know, kind of the impact investing sector as a whole has struggled a bit to come up with a coherent set of performance metrics. Our approach is to integrate these types of tools into our process as long as they are things that the business would track on their own, and they help us create kind of this common discourse or syntax for channeling more capital into the space. And we feel that the SDGs are one of those things. So we do align each of our investments with 3 SDGs and track based on those. And I'll conclude by saying, we most definitely were the first to admit that we don't have this all figured out, and we're constantly learning and growing and changing our method and kind of borrowing ideas from our peers. And so we're really excited to be part of this webinar to share what we've been doing and also to hear thoughts, pushbacks, and kind of ideas on how to improve and grow.
Thank you so much, Grace, Michael, and Sara, for sharing your insights and perspectives on this. It's really interesting to hear more about what this looks like in practice. We have lots and lots of really good questions, so we'll just jump right into some of those. Let's start, Michael, a question for you is if you could shed a little more light on how you measure the depth of your impact and how you ensure that or how you compare depth across different investments. We're getting a few questions on that topic.
Yeah, of course. This is, I think, the most ambitious thing about our approach. And, is this universal scale of impact depth. And so what we've chosen to do is we've chosen to be explicit in how we compare health, education, and income outcomes. We've done that because ultimately choosing between competing proposals inescapably means that we are making these comparisons. And so in this framework, we've chosen, somewhat ambitiously, to make that trade-off explicit. For easier estimation, you saw on the slide, the scale is relative to a typical beneficiary's annual income, so that makes it easy for estimating income benefits. But that doesn't mean that we only care about income. And so when we look at innovations that might have an impact on health or an impact on education, we draw on the best-in-class health economics and education economics literature to see how people themselves trade off different types of outcomes. And so in health economics, there's a long literature looking at DALYs and willingness to pay and other metrics that help us to give us some indication, some rough sense of what the trade-offs are between an illness avoided, for example, what that looks like equivalent to improvement of 10% of your annual income. So these are assumptions that we're making, and we're cognizant that the underlying literature itself is sometimes uncertain, and so we do sensitivity analysis to understand how different assumptions around our conversion rates affect different orderings of our portfolio. But what we've found, again, I think it's mostly because of our venture capital style approach, is that oftentimes it's just being able to see, is this a really big win or a very small win, and that enables us to screen out the small wins and focus on the really big wins. But that's a little bit about this kind of depth of impact, and again, we'll draw on kind of the evidence. For example, if we were making an investment in digital financial services, we'll look at what is the evidence of digital financial services in other markets, what is the evidence around impacts on income or around resiliency, and we'll frame that in terms of benefits in income equivalent units.
Thank you. We're also getting a few questions about the initial impact assessments that you're conducting. Grace, maybe you could answer this and share a little bit more about how your initial impact expectations for various investments have tested against the results, and what you do in the cases where you find that a company is underperforming what your impact expectations were.
Yeah, sure. So this is also closely aligned with kind of our financial projections and how we expect our companies to perform in terms of scaling across multiple customers from a financial angle. But what we do is, we always receive a model from our potential investees that outlines how quickly they think they're going to scale over time, and to which types of customers and with which product. So we use that as a baseline and probe if needed, if that's not outlined explicitly, to get a sense for, do we think that this company is going to achieve the breadth in terms of impact that we hope it will. We use that as our baseline, and entrepreneurs are notoriously optimistic, so we often cut those projections and haircut them in order to bring them in line with what we think is more realistic, and definitely hold our entrepreneurs and our portfolio companies to those metrics over time. And we look at quarterly results as well as annual results in order to do that. And to the second part of your question, if we see divergence from what we expected to see, both from an impact and financial perspective and what is happening, we often either have a board seat or have a very close relationship with the entrepreneurs in our portfolio, and we work closely with them to figure out strategies to get them back in line. And sometimes you see cases of kind of impact creep, so serving a different customer base than the company originally expected to serve, and that gets a little bit stickier in terms of if the financial viability of a company is threatened, and they have to move up market. That's a deeper conversation to be had with the entrepreneur as to whether that's the best strategy financially and impact-wise, that hopefully you have co-investors that have similar motivations to you.
Thanks, Grace. Sara, the next question is for you. How do you think about impact measurement and management across your full portfolio? Does it differ by asset class? And within that, what role does ESG play?
Yeah, thank you. So this is a really important question, in part because I think the responsible investment field is really grappling with this right now. The short answer is that we don't try to measure impact in a very consistent way across every asset class or every portfolio. I'm not sure that would be possible or even really advisable, given that all of those strategies tend to have a different intention when it comes to impact. So we have examples of public market mutual funds that really focus on achieving measurable social and environmental impact, and you can drill down into specific impact metrics based on the underlying projects that are invested in. I would say the intentionality is really strong there. Similarly, the impact investing portfolio that I spoke about earlier, the intention is baked into the reason that that portfolio exists. Meanwhile, a lot of our ESG strategies, impact may be a secondary focus or an outcome of that, but not necessarily driving investment selection or focusing on any specific theme. So for an ESG strategy in, say, public equity, we might think about impact being measured more as the ESG improvement in those holdings relative to a benchmark. Another, I think, overlap in this space is the use of ESG integration in support of any investment strategy as part of due diligence. So that's a role that I've played in one of our direct investments in a smart glass company. That involved the responsible investment team helping to evaluate the company against relevant ESG factors that mattered for their business to help understand potential risks and opportunities. But I would just differentiate that from measuring the impact that that company created after the fact. So I think those things are complementary, but it's easy to, I think, get a little muddled when we think about what these terms really mean and where they're actually quite different from one another.
Great. We're also getting a number of questions about how you align your impact measurement and management strategy with the interests of your investees. And part of that is thinking through the metrics and the way that the data are aggregated and presented, but also thinking about the role of additional non-financial support. It'd be great to hear from each of you a little bit about this question. Let's go in reverse order and start with Grace, and then Michael, and then Sara.
Yeah, sure. So in terms of aligning impact measurement strategies with your investees, I can't emphasize how important that is. The last thing that you want to do is be, the one that's asking for an entrepreneur's very scarce time to aggregate spreadsheets of impact metrics that may be meaningful to them intrinsically, but not necessarily a top priority in terms of building and growing a company. So it's important to be proactive about and be proactive and candid about what you need as an investor and what you'd like to see from the management. And for us, we don't have LPs. We don't necessarily have very strict reporting requirements. So we let the management team take the lead on this. We say, what do you think the impact of your business is, and what metrics are you using to manage towards that? And we always invest in entrepreneurs that do intrinsically care about what their impact is. So we come to a consensus on 5 or so very easy to measure operational metrics that they would already be tracking, whether that be in their CRM or their ERP or through other tracking systems that they have in place. So that's really important. And then in terms of portfolio management and ongoing engagement, we try we always check in with our portfolio companies quarterly at the very least to get a brief update. And part of my job is helping to often devise basically a quick, easy to put together dashboard to share with investors. I help the management teams do that right up front as soon as we've invested, so we know what the expectation is, and they can quickly churn those out quarterly or annually or whatever it is. So I think it's helpful as an investor to align up front and then provide ongoing support in terms of making it really seamless and easy for those guys to keep track of their impact over time.
Yeah, and I would just echo a lot of what was already said. Of course, GIF does seek that alignment up front, and one of our key investment criteria is measuring success. So if the firm does not share the same values in terms of impact orientation, then we clearly will not be a good fit. That said, we also understand that our entrepreneurs are on the for-profit side, they're business people, and they're not impact measurement people. And particularly, we're investing anywhere in firms from very early stage to somewhat more mature stage. For the early stage companies, they do not necessarily have investment relation staff or portfolio staff. So for those firms, we also have the ability on a case-by-case basis to sometimes supplement our investment with some grant capital in order to invest in some of that grant, impact measurement stuff when and where it's appropriate, and also, most importantly, when and where we think that evidence generation or where that impact measurement is going to be a key driver that can unlock future scale. Whether that means because the company wants to work more with the government and wants to demonstrate that to the governments that they're having an impact on their end users, or wants to attract capital from other much larger DFIs, for example, that are interested in the development impact of these companies. So that's a little bit about the way that we relate with our portfolio companies.
I guess I'll just wrap up here. I think our outlook on this is a little bit different from Michael's and Grace's because we are primarily an indirect investor. So when we are engaging with our GPs, we are typically engaging with what is already a relatively sophisticated impact measurement and management practice embedded in each GP. So I think certainly, from their perspective, they are certainly trying to align those metrics that they're capturing with the business objectives of the portfolio companies. But then when you zoom out to our level, I think our role is helping to find those commonalities within GPs within certain themes. And we have seen examples of where we see a best practice in one GP, and as part of our sort of scan of what we're getting from everyone, we're able to spread the use of that best practice to others. So, for example, uncovering a really useful metric around the differential to market rent in our affordable housing theme, we were able to ask some of our other GPs to start reporting that. They might have been tracking it already, but they might not have been reporting it to us. And in one case, one of our GPs actually took our standardized template in affordable housing and adopted it as their own reporting framework for all of their LPs. So I think it is a little bit of a different role, but equally important in that LP outlook to try and spread some of these best practices and reduce what Grace was talking about, the profusion of different approaches that can be confusing for investors with different language, different metrics, et cetera.
Great. Thank you all for sharing that and for helping better clarify the relationship between these different layers of capital and going from the LPs to the GPs to the investee and thinking about the role that each of these actors has to play in impact measurement and management. This hour has really flown by, and so I'll just close it up here and acknowledge that there's a lot of questions that we didn't have the opportunity to answer today. But that said, we do have the second webinar next Monday, January 29th, from noon until 1 p.m. Eastern Time. And this will dig a little bit deeper into some of these issues as well as the specific challenges that impact investors face within their own organizations and across the industry and the ways that they're working to address those. I'd also encourage everyone to read the report that we drew some of these findings from. It's available through the research page of the GIIN's website. And lastly, our IRIS and Impact Measurement and Management team has produced a number of really critical and useful resources on this topic, which can be found through the IMM page on the GIIN's website. This includes IRIS, the catalog of metrics, as well as guidance around how to use those, and Navigating Impact, which is a resource for organizations newer to impact investing that are looking to connect their theory of change to the specific evidence-backed metrics and strategies for understanding and improving that. And so all this can be found through the GIIN's website. And just want to extend one more thank you to our speakers today. to Sara, Michael, and Grace, as well as to Abhilash for joining us as well, and to all of you on the line, because of course it's your support and interest that is really key to these events and for ongoing content. So thank you all very much. Please stay tuned for the slides and the webinar recording, which we'll post online. Have a great day.